welcome to the Mortgage and Protection event panel discussion. I'm delighted to be joined today by three gentlemen representing some of the country's building societies. So welcome to Dick Jenkins, former long-standing CEO of Bath Building Society, recently retired and now lending his wisdom to Buckinghamshire Building Society in the role of chairman. Please welcome Jonathan Stinton, head of intermediary relationships at Coventry Building Society. And last but not least, we have John Truswell, head of intermediary mortgages at Newcastle Building Society. Well, chaps, as we know, it's been a heck of a year for everyone, including those in the mortgage industry. So I'll go straight in with an open question. How do building societies adapt to the lockdown crisis? And I'd like to put that question first to John Truswell, please.
I think we adapted in many ways as everyone else had to, which was a real focus on keeping services going. The first instance was getting 1,200 people deployed to home, which we managed to do in 3 weeks. And the other key logistical piece for us was keeping branches open. We clearly have a large community of customers who need cash, still needed to get their hands on cash for transactions. So it was making sure that we facilitated the branches staying open and managed to keep all our branches open throughout COVID. A fair bit of restricted timing on some, but we've managed to keep it going. And obviously, as lockdown has hit us again, we're now back in a position where we just continue to do what we've done all the way through. I think the key focus really was just about making sure that we continue to operate and offer the services that we have done, hopefully seamlessly, I think, as we've gone through it.
Jonathan, same question to you, please.
Yeah, as John has said, COVID's clearly been very disruptive to the entire market. And for us, service is always really important, as is the safety of our colleagues and also our members in a broader sense. I think we did a really good job very quickly creating a virtual call centre by moving our telephone advisors to working from home. And we actually did that a week before lockdown by supplying them all the technology they needed. So this has allowed us to have a BAU approach, and it's allowed us to keep our call centres open and functioning. We also had to deal with mortgage payment deferrals, but we were agile enough to flex in staff from other parts of the business to deal with these without overly impacting intermediary service. Of course, as John has said, we've now entered another extension period, and we'll gear ourselves up appropriately on mortgage payment deferrals. There have been spikes in our service, and to give you an example, our worst average call time for new inquiries back in March was 127 seconds, but for October, our average call wait time for new inquiries was just 25 seconds. So I think we've handled the situation very well considering. The criteria changes also had to happen, but by trying to make sure that we did these in a clear, concise way to help our broker partners and give them enough time to deal with these challenges and changes also helped.
Dick, on the whole adaptation issue, how did you do?
Yeah, pretty much the same as the other guys. I mean, one of the big challenges for all operators in the market was to really get on top of this home working issue. There are many new challenges that many of us not really come across before. The odd person home working here or there, but to get everybody to be able to do that in an effective way was quite an achievement, actually. Also, as Jonathan's mentioned, the getting on top of the payment deferral situation, the payment holidays, required us to invent a whole new process to be able to actually deploy across a large number of staff. That wasn't easy, but again, I think where there's a will, there's a way, and we got hold of that pretty quickly. One of the things that came early in the lockdown was, of course, a rates change, a very substantive rate change, down to a back-base rate of 0.1%. That caused us a lot of issues in terms of thinking about how best to balance off the interest of savers and borrowers, because clearly savers have been having a bad time, but then again, things weren't going to be that easy for borrowers either, and getting that balance right certainly caused us quite a lot of discussion actually to actually make that change. Also, as Jonathan mentioned, there have been criteria changes. Fears that house prices would drop, as it happens, they haven't dropped in the way that we might have expected, certainly caused a lot of lenders to pull the reins in and drop their maximum LTVs. And we're left in a situation where we're sitting there thinking, is this a threat or is this an opportunity? How do we best play that? And that's actually quite an interesting sort of challenge for a very small building society, because we're very interested in doing some of the stuff that bigger guys can't or won't, but finding a way of doing it safely. So those are the changes really we've seen most evidently.
And do you think that the smaller societies like yours, Dick, for example, were able to be more fleet of foot and make those necessary changes more quickly than the big banks, perhaps?
Quite possibly. I think our small scale certainly enabled us to get on top of some of the various challenges faster, because a very small organisation has very short lines of decision making. Decisions can be made quickly, and in this situation where you've got to make an awful lot of decisions quite quickly, being able to do that with a small group of people, very, very helpful to be able to do that. And I think small building societies generally have been able to rise to the challenge rather quickly on that. So I think that's good. And even if from sourcing a few laptops for people to sort of devising home working rules, all of those kinds of things have actually been able to be done quite quickly for small societies. Yeah.
And sorry, I'm confusing us already. Jonathan from Coventry, obviously not such a small building society, but do you think your size helped you to react more quickly than, say, some of the big high street behemoths?
Yeah, I think our size and also the makeup and how our business is designed. I think the businesses that have all the facets of larger banks, like current accounts, personal loans, and business banking, they had other challenges to deal with. As you've said, Paula, we're quite a large lender. We're still a top 10 lender, so we deal with volume. But our business model is really simple. It's mortgages and savings. So it doesn't mean there weren't challenges. It just means there were quite a few less of them.
Yeah, excellent. Just next question. Building societies are, of course, mutual, owned by and run for the benefit of consumers, or their customers rather than shareholders, and they perhaps have a more caring image, don't they, than faceless banks and other lenders. In times of crisis like this, do you think that propensity to be more understanding of people's circumstances came to the fore? And can I put that one to John T, please?
Yeah, that's an interesting question, Paula. Do we think we're more understanding? I think we like to think we're more understanding, and I think given scale, and there is quite a large diverse scale within the building society movement, but a number of us are very much wedded to our local communities, particularly as we are in the northeast. It does make that focus more real when you're dealing with people who are on your doorstep rather than probably some of the more national organisations. So our model also is one which has more touch points than a more automated decision-making process. So I think we are a lot closer to each customer that comes through the door because we spend more time from a manual perspective in terms of our underwriting approach and how we process the cases. We're naturally more used to those increased level of touch points as cases go through. We also have an approach which is much more flexible. So we have to be, we don't play in the volume market. We play in a market which is much more nuanced and taking each case on its own merits and trying to understand the customer and their needs. And I think particularly when you're looking at the arrangements around furlough, bounce back loans for self-employed and the pure assessment of self-employed individuals, because our core business is very much focused around making lending decisions which are bespoke to each individual. I think it certainly allowed us to probably interact with a wider range of customers and help a greater range of customers than probably would have had to, largely because I don't think they could find a home elsewhere and came to us because of our approach. So I think in some respects, it certainly played to our strong suite in terms of how the market developed through COVID. And so, I think we can bring some of that expertise to bear and maybe seem to be more helpful through this process. But I think we've got to be fair, and I think the guys have mentioned it already, some of the push and pull on the other lenders, particularly in how they had to deal with other elements of their business. I mean, we are much focused on just traditional lending rather than current accounts and business loans. I think you've got to actually say, the push and pull in other parts of the market meant they probably couldn't focus as closely as we could, largely because our model is geared just to provide that focus in the first instance.
Yes, Dick, you were nodding away there. Anything to add to that?
Yeah, I would agree, actually. I think that the stance that we have in terms of underwriting has been very helpful for dealing with customers. We are just used to being flexible and, taking each case on its merits and trying to work out what to do. And when you look at the range of circumstances that borrowers have had facing difficulties of furloughs and reduced hours, reduced pay, and all those kinds of things, when you actually multiply those through together, it's almost like a situation where everybody is an individual case of their own, and therefore having that kind of philosophy that says, well, we're going to find a solution that suits you, and actually having the flexibility and capability of doing that actually was really helpful. I think it's helped us manage the payment holiday situation much better. And I think also that when things are scary, and believe me, they have been scary actually at times this year for borrowers, then I think actually trust really is important. And organisations like ours, building societies, and particularly smaller players in the market, I think we have a level of trust which enables us to probably have better conversations than we might otherwise have had.
Jonathan, actually, obviously, as a much larger top 10 lender, do you have the same benefits, the same flexibility, the same ability to treat people as individuals, given that you're doing volume?
Yeah, I think if we look at it from an individual case underwriting perspective, unfortunately, we wouldn't be in that space. But again, it just highlights the value that having different societies of varying sizes in the market comes to place. I think the fact that we've been able to maintain open and sort of frequent contact with the advisor community in terms of what we can and what we can't accept. BDMs being available for Zoom, being available on the telephone, new lending teams being available, underwriters understanding that there's a client at the end of every application allows us to give us that extra bit of insight in terms of, is there a way that we can do this deal? But in terms of manual underwriting, as you've already said, we are of a scale where we wouldn't be perhaps in the same space as my two colleagues on the call.
You have brought me nicely onto my next question, though, about advisors. Has your caring approach extended to advisors? How important are advisors to building societies, and what efforts have you made to work with the broker community during these difficult times? Dick, if I could come to you first on that one.
Yeah, I think, again, when the market sort of enters a period of chaos, and goodness knows we've had a fair bit of that, you really want to be able to pick the phone up and talk to the person at the other end of the line who's handling your case. And there have been times when, we've perhaps had to figure out, well, hold on a second, what are we able to do with that in the current circumstances? Where we, for example, had, long delays on valuations and solicitor searches and things of that nature. It's been quite difficult to give people the answers that they need. But the fact that you're there talking to them and proactively picking up the phone to brokers actually, does make a huge difference. Brokers really actually welcome the opportunity to talk to the horse's mouth and get an answer. I think that's what we've been able to do. And I think building societies generally, from my understanding of the way that things have been played, they've done very well in that score.
Excellent. John, same question to you, please. John T.
Well, intermediaries are hugely important to the Newcastle. It's 95% of our mortgage origination. So, it's hugely important that we keep them informed about what's happening. I think one of the key things we've tried to do through COVID is just have that clarity of communication. So if criteria is changing, we're telling them what's happening. If rates are changing, although this has been difficult, and I think a number of lenders have been challenged and had to pull rates quite quickly, we have tried to make sure we give sufficient notice and signpost when products are coming back. I think, again, it's, as Dick mentioned, it's that interface with the operational staff as well, having the ability to talk through with underwriters and clearly find out what do they need to provide to help that customer's case progress through the pipeline. I think has been a key thing for us, because things have changed so much and impacted individuals. One party may be working, one party may be furloughed. Can that case still go ahead? And in many cases, we found ways to make it work for the customer based on those conversations that were happening with underwriters. So I think for us, yes, intermediaries are massively important to us. And I think we've tried as best we can, and hopefully we appear to have succeeded, to try and just keep that line of communication as open as best we can. And again, as the market continues in challenge state, that's something we'll continue to build on.
Thank you for that. Some of the main bugbears advisors have expressed with lenders during this year have been slow service and rapid product criteria changes, which we've touched on. But could you talk a bit more about how you've approached those problems? And that's Jonathan from the Coventry. Jonathan.
Sure. Well, hopefully we're not in that category, but because we've really tried to maintain a strong service offering throughout. We launched 90% on various occasions throughout the last 6 months, and it's been very successful. So thank you to everyone who supported us on that. And we've also got our intermediary pledges for product withdrawals. So in terms of removing products and changing criteria quickly, hopefully the 48 hours notice on the product withdrawal has really helped. And our 90% is a really strong reinforcement of that, because even though the product was only available for 2 days, it gave brokers sufficient time to be able to engage with their clients and advise them whether or not this was the correct route for them to go down. BDMs being available for discussions on the telephone, having telephone advisors that are there to able to answer the telephone quickly and help you with the queries. As I've already mentioned, underwriters trying to have a pragmatic approach on individual cases and picking up the phone and speaking to advisors. There have been criteria changes. We've tried to minimize them, but they've had to happen. Communication and clarity are key. Clear guidelines on what we want and what we need will help, but it doesn't get around the fact that there have been a lot of examples in the marketplace of slow service and changing criteria. I think for me, if I was an advisor, I would stay close with the contact points that you've got with each of the lenders, understand their current position, and then base your advice accordingly.
Good tips there. Dick, anything to add to that question?
I tend to agree with that. I think it's been an understandable frustration for brokers, and I think brokers need to also appreciate that many of the problems that we've had in giving good service have been somewhat out of our hands. These are, some of the problems with staffing, where we've had staff going off self-isolating, where we've had situations where solicitors and valuers have not been working at the speed that we normally would expect them to do so. And of course, I realise that brokers will always tell us that the lenders let us down here, but sometimes we're waiting for other people in the chain. But I think it's been an understandable problem, but we have actually bust a gut to try and do everything we can to keep the show on the road for the brokers. I mean, we do nothing but intermediary lending, and we try to think broker at every stage, but I won't pretend that it's been easy, and it's certainly not been seamless.
And following on from that, in recent years, many building societies have been hotbeds of innovation, if you like, haven't they? Coming out with all sorts of products, from mortgages with parental support to holiday lets. And we've touched on the manual underwriting. Has innovation been stymied this year by the challenges of COVID? I'll put that one to John T first, please.
I think innovation, yeah, I think naturally, given, and we've talked about it quite a bit so far through the conversation, and I think given the push and pull that's in the marketplace, and the way that lenders have had to adapt processes and services to manage, the different elements that COVID has thrown at us, I think it's natural that innovation would slow. I mean, certainly from our own perspective, there have been a number of products that we would like to have kind of brought to market this year. They will still come to market, but again, COVID has meant it's probably not been right and appropriate to bring them into play. But I do think you've seen lenders kind of adapting current product set to meet the new demands as well in the marketplace. So, for example, we have a joint mortgage sole proprietor product, which primarily was aimed at first-time buyers using parental support to get onto the ladder. What we've seen as the COVID has created probably a different set of drivers in the marketplace, unfortunately people splitting up as a consequence of probably having to spend a lot of time together. And we've evolved that product into one which supports people who are probably later down that borrowing curve, to help them either maintain the presence in the family home or move to a different property. So I think there's been elements of a kind of new product innovation, probably not to the extent that we may have expected, but I think we're still waiting to see what the outcome is of COVID. And, particularly as you look around the LTV challenges, with product being available fleetingly really at 90%, then I still think there's a way to go with this, but I think we just need to see the full impact of COVID first before we start to see innovation move forward again.
And Jonathan, Coventry, Jonathan, same question to you, please.
Yeah, I think, to echo John's point, there are lots of things that all lenders want to do and bring to market. And unfortunately, these will have been impacted because of COVID and other third-party situations that maybe were there to help deliver that. Doesn't mean these will be forgotten, and I'm sure they'll be launched when the time is right. For ourselves, we've tried to continue to evolve. We've launched interest only with offset, as I've mentioned, 90% loan to value. Broker feedback is really important to us, and one piece of feedback that was consistent right across the country was fixed rate deals with no ERC. So we've been successfully been able to relaunch those things back into the marketplace. And I think during a COVID period, again, if I sort of steal some of John's words around, are there situations where people will want to get out of their deal early for one reason or another? It's an excellent choice to do that. But everybody wants to innovate, everybody wants to drive forward and wants to improve the offering that they've got. Unfortunately, this has just been a bit of a speed bump in the road, all bar the horrible personal sacrifice and personal situation this brings across the whole country. But things will get back on track whenever the time is right, and I'm sure we'll start to see innovation come through again.
Dick, what are your thoughts on innovation?
Well, I think, as the others have said, inevitably keeping the show on the road has taken our eye off innovation for a while. But there's nothing like a crisis to bring innovation, and I can see great opportunities arising out of this. I mean, I give a couple of examples. The Buckinghamshire has just recently launched a 90% LTV mortgage for NHS staff and care workers in the Buckinghamshire area. Okay, it's something we can do, but it's a constant product that's out there. I think we can also find ways of helping people to secure further advances to improve their home working situation. That's an opportunity. Of course, there are more staycations that are going on at the moment. None of us can fly anywhere, so staycations probably brings renewed fillip and an opportunity for the holiday let market. And I think those are sort of the kinds of opportunities that sort of seem to be thrown up by this. And I'm actually quite excited at some of the things that we can be doing in the context of COVID. Of course, we do have to keep the show on the road. We do have to stay on the straight and narrow just for the moment. But I think you will see 2021 bring in lots of opportunities for lenders that are prepared to try a few things and experiment. I think it could be very good.
Excellent, lovely positive note there, a COVID silver lining. We're all for grasping those. Which brings me to my very last question. If you could just answer this one for me, chaps. As we don't think things are going to return to normal in the foreseeable future, what words of advice would you offer advisors looking to protect or even grow their business over the next 12 months? So concise answer, please. First from John T.
I think the most important thing is just stay close to your clients. I think at the moment, there is no time where an individual needs good professional advice than now. So, stay close to your clients, make sure you read the circumstances, talk to your BDMs too. I think Jonathan mentioned it earlier. Have a chat with your BDM. Your BDM will know how to help. If you're stuck, don't know where to go, or have a client who is challenged, have a chat. If they can't sort it themselves, they'll know where to go. So I think it's use the resources around you and stay close.
Thank you for that, John. And Jonathan?
Yeah, again, don't miss the massive opportunity that sits with your current mortgage book. You do a great job securing new clients, and we know you're very passionate about getting them the best deal, but don't assume they're going to automatically come back to you. So again, as John has said, understand how lenders approach different situations, speak to your BDM, speak to your contact point. But to finish off, what I would say is don't overlook the technology aspect of it either. There's lots more tools in the marketplace today than there were this time last year, from criteria sourcing, the affordability systems. That will help you understand how to get things right first time and minimize the amount of time that you're spending on each case. Your advice is sound, and if the paperwork is sound and you place it with the right lender, you're absolutely going to grow through efficiencies.
Lovely, thank you, Jonathan. And the last word to Dick, please.
Well, I would echo that advice. Stick close to your customers. Stick also close to the lenders that you know and trust. And, you know, on those occasions where the phone is not ringing and not a lot's happening, that may be a great time to explore what building societies can do for you, because I think you'll find them a very imaginative and helpful bunch.
Lovely, thank you very much indeed, gentlemen. That concludes our debate. Thank you to all three of you, and thank you very much to delegates for listening. Goodbye.
Thank you. Bye-bye.
Bye-bye.